I hate investing in gold, but now's a good time. I hate it because gold doesn't pay a dividend. There's no profits. It just sits there. And I'm hoping that somebody will be willing to buy my gold for more than what I paid for it. But what if there was a way for gold to pay a dividend? Grab a drink, take a seat, let's talk about it. What's up, y'all? It's Brian. So Goldman Sachs just upped their price projection for gold for the end of 2025, and there is a lot of uncertainty in the markets, and it seems like the prices of gold is reflecting that. So how can I benefit from the protection from the market that gold seems to offer while still having access to a business that's actually making profits and not just investing in a commodity? My mission is to find the biggest and the best gold mining company on the market. That way I can benefit if the price of gold does continue to go up like people think it will, but if the price of gold does not go up as much as we think, or if it goes down a little bit, I want to invest in a company that is expanding its production, that's mining more and more gold. That way they can offset a bad gold price movement with company growth and more company profits. So how am I going to do that? The first step is always to go to ChatGPT. Using ChatGPT makes investing just so much faster and more convenient. So in this case, I asked, give me a list of 10 large cap gold mining stocks that are publicly traded on either the NASDAQ or the New York Stock Exchange. So straight away, ChatGPT gives me a nice list of 10 of the most well-known. And then I want to know which of these companies are the best in terms of financial health. So my question now to ChatGPT is based on liquidity, solvency, operating efficiency, and profitability. Rank the following companies in terms of financial health. And so ChatGPT does that. I break it into 2 groups of 5 because I have found that ChatGPT does better with smaller chunks. So instead of doing all 10 at once, I'll do 5 and 5 and eliminate the worst performing in each group of 5. So out of this first group, we have Wheaton at the top, Barrick Gold second, and Agnico Eagle Mines at third. So going down to third place, solid profitability and lower liquidity. So in this case, the current ratio is 1.86. but the quick ratio is 0.74. So the quick ratio is how much short-term debt do they have coming up in the next year versus how much cash do they have to pay it. If the quick ratio is below 1, then they do not have enough cash to cover their upcoming short-term obligations. However, the current ratio takes into account their current inventory. So as long as they're moving inventory, the quick ratio, it's a little bit of a red flag, but in this case, I'm willing to let it pass because they clearly have a high enough current ratio. I feel confident that they're going to be able to move their inventory, so I don't see it as an issue. However, when we go to rank 4 and 5, they have extremely high liquidity, that's good, but negative earnings, not good. So I'm going to knock out Franco-Nevada, I'm going to knock out Newmont Mining, weakest financial health. Going on to the next group of 5, Alamos Gold, strongest, Kinross Gold, second strongest. And then when I get to Gold Fields, this is the one that I'm going to knock out because they have an even worse quick ratio than the previous third place company. So this one's going to get the axe, and then so is number 4 and 5. So I've got my 5 companies. The next step is to start digging into how do these companies actually work? Are they cyclical? What kind of profits can I expect with these companies, and what are their future outlook? One thing I've found when looking through the financials of these companies is that they are extremely capital intensive. They have to invest a lot of capital into setting up a mine so that they can then profit from mining the gold. Then they also have capital expenditures to sustain a mining operation. So there's kind of 2 ways to look at the cyclical nature of these companies. How much are they investing into new mining operations and exploration, and then how much are they spending on sustaining their current operations? When I look at Wheaton Precious Metals, this company is actually a gold streaming company. They're not actually a gold mining company. So the difference here is that they invest in gold streams from existing mines where other companies are mining that gold. And then with the rights that they purchase, they get access to buy that gold at a reduced rate. So similarly, they put a lot of capital expenditures up front into investing in a gold stream, but then they do not have the recurring capital expenditures to the same degree to continue tapping into that gold and get profits. So the best metric I found to gauge the profitability of these companies is, for the mining ones, the all-in sustaining cost. This is the cost per ounce of gold a mining company has to put in. This includes the cash expenses that are required, and it is the sustaining capital expenditures. They exclude the growth-oriented capital expenditures from this figure. So what I would do is I would take the price of gold at the time per ounce, and then I would subtract the all-in sustaining costs to see how efficient is this company at getting profits. So essentially, the lower the all-in sustaining cost, this is AISC, the better for a gold mining company. And then I would compare that to the depletion costs for Wheaton, which is the only gold streaming company that I'm looking at. So the depletion cost is they take all of the capital expenditures that they invested into a gold stream, and then they divide it by the amount of time that they're able to make profit from that gold stream, and then they average that out every year. So these are the numbers that I would take into account to see how profitable are these companies. The first thing I wanted to do is I wanted to compare the profitability of these companies and the revenue of these companies to the historic price of gold to see what is the correlation here. If the price of gold is going up, how much money are they making? And when the price of gold goes down, are they losing money? So let's look at that. So here is my free cash flow analysis spreadsheet where I do all the calculations that I find are relevant for analyzing a company. And in the supplement tab, this is where I pulled the date, the value of gold, and then the revenue of all 5 of these companies. And I also did the same thing, the date, the value of gold, and the operating margin of these companies. And then at the top, I calculated the correlation for the revenue, and I calculated the correlation and the average operating margin for these companies. So the first thing to look at is revenue. So yes, as expected, there is a high correlation between the revenue and the price of gold, because obviously the more the gold is worth, the more they can sell it for. So in this case, the highest correlation is AGI and AEM. A correlation of 1 is perfectly correlated, and then a correlation of -1 is perfectly opposite. So if the price of gold went down by 1 and then their revenue went up by 1, if it was opposite, that would be -1 correlation. And then a correlation of 0 is no correlation at all. These are like randomly going in different directions. So if the price of gold goes up, then AGI and AEM are going to benefit the most. And then conversely, if the price of gold goes down, they're going to suffer the most. But I also wanted to compare that with what are their operating margins compared to the price of gold? Like if gold is going up, are their operations getting less and less efficient? Or are they still able to pull out more profit at the end of the day? Are they able to reduce their expenses and still get a profit, essentially? And in this case, the correlation for AGI and KGC, once again, these are the highest, as I would expect. If their revenue is highly tied to the price of gold, then I would think their operating margin would be as well. The one that has the lowest correlation is ticker GOLD, GOLD, 0.166. So that is pretty attractive to me. In my mind, that's going to be a bonus because I feel like it's a little bit safer. If the price of gold goes in an unexpected direction, they're not going to get hurt as bad. So just something to think about. And then down here at the bottom, I made a couple graphs just to help visualize it a little bit. This is the revenue graph. The blue is the price of gold. So as we can see, as gold goes up, all of these companies are trending up as the price of gold goes up. And if we look at the short-term drops and spikes, when gold drops down abruptly, we can see that the yellow revenue drops, the orange revenue drops, blue not so much. The next 2 pieces of information I wanted to understand is the all-in sustaining cost for the 4 mining companies, and then the future growth projections. So for each of these companies, I can go to their latest quarterly report or their latest investors relations page and see what is the company's guidance for how much they think they're going to expand their production going forward. So first, just looking at the all-in sustaining costs, I found that AGI was the most efficient in terms of sustaining costs, and they project that their cost is going to be going down in the future, which is really good. And then the least efficient is gold. So unfortunately, the one that had the least correlation in terms of operating percentage is also the least efficient in terms of all-in sustaining costs. So moving on to growth projections, KGC and AEM both are claiming that they plan to have stable productions. They do not think they're going to have more ounces of gold mined in 2025 through 2027. However, the other 3, WPM, gold, and AGI, they're all projecting about 8% growth of production. This is the amount of material that they're extracting from the ground, both gold and copper. These are the big 2 resources that these companies are pulling. So on top of the price of gold going up, we could see their production going up at the same time. So this is what I'm talking about. This is the type of company that I want to invest in for my gold exposure, because if the price of gold goes down by 8%, if I'm invested in gold, then I lose out on that. However, if I'm invested in one of these companies and the price of gold goes down while their production goes up, then their share price might not be impacted as much. The next thing I want to look at is what is the valuation, the intrinsic value of these companies? Are any of these companies on sale compared to the others based on their future projected growth and their current valuation today? So back to my dashboard section, this is where I type in the ticker of the company that I want to analyze. The first one we're looking at is WPM. So on stockanalysis.com, Wheaton Precious Metals, they're trading at about $70 per share. I'm on the forecast tab, so I can also see what do the analysts think about their future growth. So I do want to take into account what the company says about their future growth, but also I want to see what the analysts say. So in this case, I can highlight their revenue growth projections here and paste that into my spreadsheet. Now, according to Wheaton, they are expecting to grow by about 8%. So here they're showing their estimated attributable production in 2024 to be 325,000 ounces to 370,000. They're saying that they're going to go up to approximately 550 to 620 from the previous guidance. So, and this is in GEOs. This is gold equivalent. Can't remember what the O is, but gold equivalent production basically. So they'll take the amount of copper that basically gives them the same profit as 1 ounce of gold. And that way they can say, here's all of our production for all the metals that we're doing, and you can compare it to other companies that do a wide variety of metals, and they just put it in terms of gold. That's where I'm getting their 2024 long-term production outlook. Once I go back to my spreadsheet for annualized revenue growth, I'm going to use their projection here. So 3% average inflation plus their increased growth in terms of production. That brings me to an 11 annualized revenue growth rate. That would put my projection at $27 per share. Their current share price is 70. So currently it looks like they're incredibly overvalued. However, with free cash flow is currently reduced by their capital expenditures. Now for Wheaton, almost all of their capital expenditures are going towards buying up new streams of revenue. So this is more of a growth expense in my mind. It shouldn't be counted completely against their free cash flow. So I am going to adjust their free cash flow margin up. Currently, their free cash flow margin for the past 5 years is about 43.5%. That's the calculation I'm using for their future free cash flow. But if I scroll down here, I can see that currently, if I adjust their CapEx to 100%, I'm going to give them credit for 100% of their capital expenditures, meaning all of that cash is not being removed from their free cash flow. It's going into growth. That pushes their margin up to 67.5%. So going back up here, that would mean I need to increase their free cash flow percentage by 24%. That pushes their projected share price using the company's own guidance up to $40 per share. So even with upping their free cash flow by 24%, their projected share price is only 40. Now with the analyst highest projections, that puts their share price at 70. And so in my mind, WPM is overpriced. I'm not interested in purchasing this company because even the highest analyst projections put their fair share price at even. And that's giving them credit for all of their CapEx, which is probably a little bit extreme. The second company I want to analyze is Barrick Gold Corporation. So these guys have a projected revenue growth of 32, 25, and 13. But judging by the revenue growth here, there is a wide range of what the analysts think is going to happen. And what's really jumping out at me is in 2028, the analysts think that their revenue is going to drop off big time. So maybe analysts on stockanalysis.com are thinking that the price of gold is going to drop off, which I find is interesting because Barrick Gold was one of the companies that projected expansion for the next 5 years. So if I go to their future guidance, these bars here are showing their total production. And I did the math here. This is an 8% year over year growth in production. That's what Barrick Gold is projecting. So I'm going to keep in mind what the analysts are saying, but I'm still going to use my projection of 11% revenue growth for the next 5 years. And then I'm going to go with 3% growth from here on out. Just having gold go up with inflation. So with that in mind, my projection is $18 per share. Barrick Gold's current share price is $18 per share. And then looking at what the analysts think, it does not look very good. Now, this does not give Barrick Gold any credit for their capital expenditures. So remember, for a gold mining company, the capital expenditures are broken up into two categories. They have their sustaining capital expenditures and then their expansion capital expenditures. So I did the math on what percentage of their CapEx is growth related. In this case, it's only 17%. So I'm going to go into the CapEx adjustment column. I'm going to give them credit for 17.8%. of their CapEx. That means that their free cash flow margin is now about 16%, which means I need to come over here and give them credit for another 4% free cash flow, which does up their projected share price. For me, 26. The range of analyst projections is now 3 to 20. So for my projection, it looks good, but since the analysts are projecting a big drop off in 2028, that does a little bit of a red flag. So right off the bat, I'm thinking maybe this one's a little bit too risky. The next company is Agnico Eagle Mines Limited. This company is currently at $98 per share, and their future guidance looks a little bit similar, except they're showing growth in 2025 and 2026. This is according to the analysts. But then in 2027 and 2028, I'm seeing big red bars. So that is a little bit of a red flag. I already put that information into my spreadsheet, and the results are $75 per share is my projection. I should also mention that I reduced the annualized revenue growth for the next 5 years to 3%. This is just increasing with inflation. I'm assuming that gold is just going to go with inflation. They are projecting stable production, so I'm not giving them any credit from their own guidance in terms of production. So this annualized revenue growth, that ties in with my projection. So I'm seeing 75. The spread of analyst projections are from 82 to 31. So this company looks like it is a little bit overvalued. Definitely not going to be investing in AEM. The fourth company is Kinross Gold Corporation. So this company is currently at $11.54 per share. Looking at their future revenue growth projections, looks similar to the previous two. We're seeing big drop-offs according to the analysts in 2027 and 2028. This must be that the analysts think that the price of gold is going to drop, because this company also has given stable production guidance for the next 3 to 5 years. So with that in mind, going back to my spreadsheet, so I went ahead and put in all the information already, got 3% growth. I gave them credit for an additional 11% in free cash flow margin, because according to their sustaining capital expenditures versus their growth capital expenditures, this company spends about 50% of their total CapEx on growth. So I gave them a lot of credit in terms of free cash flow. With that, my projection goes up to $19 per share. Considering their current share price is $11.63. That's a pretty significant upside if their production does not slow down, which the company guidance says it won't, and if the price of gold continues to just edge up with inflation. So if that happens, then we're looking pretty good. However, the analysts clearly do not think that's going to happen. The average analyst projection puts their share price at 11. So this one's average in terms of the analysts, and it's underpriced in terms of my projection. So this one's a little bit questionable. The final company I'm looking at is Alamos Gold Inc., ticker AGI. They're currently trading at $23.5 per share. And when I scroll down to the analyst revenue growth projections, finally, I'm seeing all green. So this looks really good. There's only 1 year where the lowest projections think they might shrink a little bit in 2026. When I go to the company's guidance, this company says that they're going to be expanding their production every year by about 8% on average. So I'm giving them credit for 11% growth over the next 5 years. That's 8% for their production, and then another 3% for gold increasing with inflation. I'm giving them credit for 27% boost to their free cash flow, because this company spends a significant percentage of their capital expenditures on growth. When I go to their financials, they spend about 74% of all of their CapEx goes towards growth. So I'm giving them credit for 74% of that back. And the result is my projected share price of $29 per share. And that's using the company guidance for future growth. Given that their current share price is sitting at, 23.5, my projection gives solid upside. And then when I look at the analyst projections, it's even better. So using the analyst projections for revenue, the lowest share price for free cash flow would be $32 per share, and the high end is $58. So in my mind, the company that has the best upside and the best protected downside is AGI. That's Alamos Gold Inc. So if I want exposure to gold in 2025, which I do want some because there is a lot of uncertainty, I'm going to invest in gold mining, and I'm going to invest in this company. If you enjoyed that video, you might also be interested in investing in black gold. Check it out right here. Cheers. Where's the cats? Oh, Momo.